Good morning, welcome to the Australian Early Finance Briefing for Tuesday, the 25th of August 2020. My name's Nick here in Melbourne. Starting with the market darling Afterpay, hit yet another record high yesterday of over $82 a share. Just a reminder, it did hit just above $8 back at the end of March. It's announced a takeover of a small Spanish firm called Pagantis. It's a startup credit provider. It's only cost them 50 million euros. It's a strategy consistent to what it's done in the past. In the UK, it bought a company called ClearPay to establish itself in that market, and it's worked out terribly well. The UK is now one of its biggest markets, and it continues to expand rapidly. So this will essentially form part of their strategy to launch into continental Europe, somewhere which really does not have much of a buy now, pay later market established. Afterpay in their announcement said that they estimate the size of the European e-commerce addressable market to be about 500 billion Australian dollars. So it's waiting to be tapped, and it's going to sort of view it in the same way as they did with their ClearPay acquisition. So promising news there. It's also worth mentioning that Afterpay reports on Thursday, and I do have a holding in that company. Now moving on to another company that's done exceptionally well this year, but not as well as Afterpay, which seems crazy, but Tesla, it's up just under 400% this year, and it's recently breached the US $2,000 a share barrier, and it has announced a stock split, but that's yet to come through. And it's really sort of shifting some of the analysts' expectations for the price. So it's currently at about 2,044. It closed on Friday, and the average price estimate amongst 24 analysts is $1,290. So it's almost double its mean estimate. However, the high end of estimates is at 2,600 a share. So a substantial rise from where it is now. Analyst Dan Ives has mentioned that he estimates that it could be worth $2,500, and Gary Black, former chief executive of Janus Capital, has upgraded his valuation to $2,700. So certainly lots of growth happening in these high growth stocks around the world. So one question on a lot of people's minds is, what's going to be the impact of Joe Biden winning the US elections? Now, Mark Holbert at Dow Jones has done an analysis looking at the performance of green stock, like renewable energy, and sin stocks, oil, gas, etc., versus the implied probability of winning from the online betting markets on betting who's going to win the election. So we're sort of looking at the quantitative likelihood of say Joe winning versus the performance of green stock on the market. And he wasn't unable to find any statistically significant correlation within a reasonable confidence interval. So it's his basic thesis is that where you're seeing a lot of analysts saying, get into green stock now because Biden might win, it's not really supported in the numbers. So what he says is, some believe that if Joe Biden becomes the next US president, investors in gold as well as shares of Chinese and clean energy companies will have reason to cheer. If President Donald Trump is re-elected, in contrast, those investments will be hurt, but shares of oil, gas and coal companies should rally. So he's saying, people are saying these sorts of things, but they're not really checking the numbers. And he says, basically, at the end of the day, other factors will have a far greater impact on stock prices than the winner on election day, and that market participants should be focusing on these other factors rather than playing these Wall Street parlor games. If you're a regular subscriber to this podcast, you would know that we've covered a lot about the impacts of the vaccine on markets and whether the pricing in markets reflect the impact of the likelihood of a vaccine. Now, UBS in the US has done a bit of an analysis to actually quantify the impact of this news flow. So Dow Jones mentions that they did an analysis to look at positive and negative vaccine-related news and how that moved the S&P 500 leading US index since May. And they found that optimism around the vaccine adds about 6.5% to the S&P return since May. So it sounds like a lot, but the S&P's gone up a fair bit in that time. So it's still a significant amount. Now, how did they do their analysis? So they calculate the impact by measuring the number of shock days. That's what they deem days in which the S&P 500 moved up or down by at least one standard deviation versus the average daily movement. Now, they've mapped that against a model they use for economic policy uncertainty, and looked at how much the vaccine news contributes to their economic policy uncertainty index. And they found that investors have priced in 33 to 40% probability of a vaccine on the S&P 500. But interestingly, a number of analysts have said that shares in companies with the most to gain from a vaccine, i.e. hospitality and leisure stocks, have barely outperformed the S&P 500 since May, suggesting that a vaccine isn't really priced in across specific industries. So you take that as you wish. That could be a strong buy, a potential market mispricing, or something else at play. And to the markets, a lot of positivity this morning in the US just after open. The S&P is up about 80 bips along with the Nasdaq and the Russell. There's some positive news flow once again regarding the vaccine. AstraZeneca's price is up 4%, and that's on the back of an FT report late yesterday mentioning that Trump may look to fast track the approval of this vaccine using emergency approval rules to allow this vaccine to be out prior to the completion of the phase 3 trials. And here in Australia, we have some more, the tail end of the reporting season. We have Qube Logistics, Ansell, Ampol, and Scentre Group all reporting today. That's your update for Tuesday. Have a great day. Thank you.
This podcast is for investment professionals only and should not be relied upon by private investors. The podcast is provided for informational purposes only and does not constitute financial advice. The values of investments can go up or down, so you may get back less than you initially invest.